In an era of global instability, the BRICS nations are striving for financial independence, breaking free from the dominance of the dollar. China's recent sale of approximately $50 billion in U.S. bonds is just another step in this direction. How will this tectonic shift impact the global economy and stock markets? Close attention to individual company stocks overshadows the broader picture, where the bond market plays a colossal role. Looking at the global economic landscape, it becomes clear that not only individuals, but entire nations are involved in the game of assets. At the heart of this complex system is the American bond market, traditionally seen as a safe haven for investors seeking stability and reliability. The global bond market is estimated to be 3 times larger than the stock market. This ratio is due to the fundamental difference between these two types of assets. Stocks certify ownership, while bonds are debt obligations. Paradoxically, debt is the dominant force in the global economy. A legitimate question arises. If the world's money supply is limited, where does the money come from to pay interest on loans? The answer lies in the constant creation of new debt to service old debt. In this system, the bond, this humble piece of paper, becomes not a symbol of ownership, but an instrument perpetuating debt dependence. The United States debt burden has exceeded $34.8 trillion. This debt, represented in the form of bonds, is actively purchased by foreign governments and private investors. Today, according to various estimates, between $7 and $8 trillion of American debt is held by foreign creditors. Raising funds through the sale of government bonds is a key mechanism for the U.S. to finance economic growth and repay previously incurred obligations. In return for the loans provided, the United States pays bondholders interest income, a kind of dividend. If we consider American bonds as stocks, their rating would correspond to the AA class, the blue chip category, which indicates high reliability and stability. That is why many countries hold trillions of dollars in their reserves, denominated in American debt, which is a liquid asset for them. However, recently there has been a trend towards changing this picture. Large holders of American debt, such as China and Japan, are gradually reducing their purchases, which may indicate a revision of investment strategies and diversification of assets. But how do all these factors affect the economy of the United States? It is important to understand that China has traditionally been one of the largest investors in American debt, and even now it remains in second place in terms of investment in U.S. bonds. However, in the first quarter of 2024, there was a trend towards a reduction in the Chinese portfolio. During this period, bonds worth about $50 billion were sold, which reduced the total volume from $816 billion in December 2023 to $767 billion by March of the same year. It is noteworthy that such a significant reduction occurred in just 3 months, and this is not an isolated case, but part of a longer trend. Analysis shows that China's reserves in U.S. bonds have been steadily declining over the past decade, reaching a minimum level in the last 14 years. There are several reasons for this development, but one of the key ones is the ongoing tension in relations between the U.S. and China. The origins of these contradictions go back to 1949, when the People's Republic of China was proclaimed. A period of relative warming in relations began only in the 70s, when President Nixon made a historic visit to China, opening a new chapter in bilateral relations. The proposal of the government of the People's Republic of China for President Nixon to visit China became a real sensation, the news of which spread around the world, plunging it into a state of shock. The scale of the surprise was so great that the authoritative publication The Washington Post compared this event to Nixon's hypothetical statement of intent to go to the moon, emphasizing that even such an extraordinary step would have caused less surprise. By 1979, the United States of America and the People's Republic of China had established official diplomatic relations, marking a new era in bilateral ties. In the 1980s and 1990s, relations between the two countries were characterized by active economic cooperation and growth in mutual trade. This period was not without challenges, such as the tragic events in Tiananmen Square, but the overall direction of development remained positive. At the beginning of the 21st century, the situation began to change. China, like any country seeking to strengthen its influence, declared its desire to have more weight and a greater voice in resolving global issues. This aspiration, as many experts noted, was quite legitimate and expected. In recent years, especially during the presidency of Donald Trump, relations between the United States and China entered a period of turbulence. The 2010s marked the beginning of a trade war, which negatively impacted both economies and led to increased tensions in bilateral relations. Unfortunately, this tension persists to this day, despite the change of administration in the White House and the accession to power of President Joe Biden. The U.S.-China economic confrontation is flaring up with renewed force. The Biden administration is imposing unprecedented tariffs on imports of electric vehicles from China. This is not about the usual 10 to 20%, but about a prohibitive barrier of 100%, designed to protect the American market from Chinese expansion. The United States continues to have serious concerns about China's technological dominance, issues of censorship, and human rights. The Taiwan issue adds particular acrimony, being a key irritant in the relations between the two powers. The year 2024 is marked by fierce economic competition, forcing many countries to reconsider their approaches to cooperation and seek ways to reduce their dependence on the American dollar. In this regard, experts draw attention to the gradual decline in the dollar's share of global reserve currencies, which began after the abolition of the gold standard. The decision to suspend the convertibility of the dollar into gold, taken at the time, was motivated by the need to ensure currency stability and protect the interests of the United States. Let's imagine what would happen if countries around the world, including China, began to massively get rid of American Treasury bonds. Such a sell-off would collapse the prices of these bonds, which would inevitably lead to an increase in interest rates. Soaring interest rates would create a colossal burden on the banking system and make loans prohibitively expensive. People and corporations would borrow money less often, which would lead to a reduction in consumer spending and, as a result, to a slowdown in economic growth. It is also worth remembering the impact of high interest rates on the federal budget and national debt. The burden of interest payments may force the government to take unpopular measures, such as cutting social programs on which millions of people depend. An alternative solution would be to raise taxes in order to somehow compensate for rising costs. The stock market will also not stand aside. Such a shock will cause unpredictable volatility, which will particularly painfully affect those who plan to retire. The lack of historical precedents will only exacerbate the situation, as the market will be in a state of complete uncertainty. Fourth, the reputation of the dollar as a reliable global reserve currency will be under threat. The loss of investor confidence in American debt will inevitably lead to a decrease in its value in the international arena. Fifth, the weakening of the dollar will entail an increase in the price of imported goods, which will create an additional burden on consumers. In response to this, the Federal Reserve System will probably have to resort to further raising interest rates in order to contain inflation. Sixth, the combination of these factors can trigger a global recession. However, not all experts share such a pessimistic view of the situation, believing that the fears are greatly exaggerated. There is also an alternative point of view, supported by data indicating the stability of the dollar. One recalls the old saying, if you owe the bank a little money, you have a problem. If you owe the bank billions, the bank has a problem. In this context, the United States acts as the bank, and other countries are holders of its debt. China faces a dilemma. Getting rid of U.S. Treasury bonds could lead to a collapse of its own investments. The reason lies in the stability of the American currency, which, despite geopolitical challenges, maintains a dominant position in the global financial system. Studies show that about 59% of global currency reserves are denominated in U.S. dollars. For comparison, the share of the euro is only 20%, and the Chinese yuan occupies a modest 3%. The dollar remains the key currency in global markets, participating in 88% of foreign exchange transactions. Despite China's attempts to diversify its assets, the trend suggests the opposite. Analysts note that 73 central banks around the world prefer to get rid of the yuan, opting for gold and the American dollar. Surveys among investment fund managers confirm this trend. Interest in the American currency is growing. A significant number of respondents reported plans to increase their investments in the dollar over the next 1 to 2 years, with this figure being 3 times higher than last year's. The euro, meanwhile, holds a modest second place, attracting only 7% of investments. Concurrently, 12% of investment fund managers express an intention to reduce their assets in Chinese currencies. Looking at the strength of the dollar, as measured by indicators such as the DXY index or the US dollar index, USDX, its steady upward trend over the past few years is evident. One of the key reasons for this phenomenon is the attractiveness of high interest rates in the United States for foreign capital, which encourages other countries to purchase American debt. In this regard, A legitimate question arises. To what extent can the United States afford to lower interest rates without facing difficulties in selling its debt? This question certainly warrants separate consideration, but the bottom line remains. The dollar's position is still strong and does not portend an imminent weakening. The data, figures, and facts presented above are based on objective research aimed at providing a comprehensive picture of what is happening. However, turning to subjective opinion, one can observe that the world has long been gradually moving away from the dollar, and this process has been ongoing for several decades. The question of how rapidly the world is abandoning dollar dependence and what the consequences of this process will be sparks lively discussions. It cannot be ruled out that what is happening is just another turn in the cycle of fluctuations of the American currency. In the history of the dollar, there have been periods of ups and downs, driven, for example, by high interest rates, as is the case now. But there have also been declines, such as after the United States abandoned the gold standard. Perhaps the strengthening or weakening of the dollar's position is just a matter of time. Economists' opinions regarding the consequences of a weakening of the dollar's dominance differ. Some experts believe that reducing the role of the dollar in the global economy could benefit the United States by increasing its competitiveness in the international arena. This, in turn, could stimulate the growth of the stock market and bring tangible economic benefits. However, most economists agree that in order to maximize benefits, the United States needs to maintain the dollar's status as the world's reserve currency. Despite the fact that no other currency can currently compare to the dollar in terms of scale of use, the United States is increasingly using it as a tool to pressure other countries, resorting to sanctions and tax measures. Events on the world stage are pushing countries to actively seek alternatives to the American currency. In times of economic turmoil, investors traditionally turn to gold, the dollar, and treasury bonds as the most reliable assets. The question of the future of the dollar's hegemony remains open. A gradual decline in its influence on a global scale is likely, but it is premature to talk about the imminent replacement of the dollar by any other currency. The most likely contender for this role is the euro, while the prospects for the yuan or a BRICS currency remain dim due to a lack of trust between the participating countries. Even China's impressive economy is no guarantee of the unconditional acceptance of the yuan as a reserve currency. Any changes in the global financial system happen gradually, requiring time and strategic